The posture has turned bullish on the S&P 500. In today's video, I'm going to show you how it did that. What are some of the positive signs that we're seeing that may lead to a little bit more bullishness going forward? And today's trade idea comes from a sector that finally had a good day and how to trade it in a little different way than you may expect. So let's go ahead and get started. Today is Friday. May the 4th be with you all. My name is David Settle. This is the Market Outlook from MarketScholars.com. Thank you very much for watching tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking or mousing over our logo in the bottom right corner of this video and then clicking on that red subscribe button. Like today's video. Right below the video, there's a thumbs up icon. Click on that. That tells me, number one, that you got something out of it. It tells me also that you want me to keep doing the video. So one click way to give me feedback. Comment on anything that stood out to you from today's video. You have to scroll down further to the bottom of this page to see the comment section down there. And of course, join our daily Market Outlook email list. There's a link in the video description that will allow you to do that. Follow me on Twitter for more content like this throughout the day. You see my handle up on the top left corner of your screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. Finally, join our Market Outlook community on Facebook. Again, in the top left corner, you'll see the address for that group. There's also a link down in the video description below that will take you there where you can join as well. All right, well, let's start off by taking a look at the S&P 500 with the market forecast indicator, and you can see here that we got, the bounce up, a close above the high of the low day today. In fact, we closed above every high this week except for Monday's high where we started off. So we closed above the last 3 days' highs. So very bullish close from that perspective. You can see just barely getting above that high. Brought the intermediate line up. Well, in fact, it got above 50 finally. It got above. See, it didn't quite get above 50 on that day. You can see right above the intermediate tag over to the left where it says 48.89. That was the intermediate line value on that day, getting up to above 50 today. So we're getting higher low points here. Here's the last intermediate low point. Now this one, a higher intermediate low point. And you could also say, too, that we're getting pretty darn close to breaking down. So here is the near-term trend line, right? So you have, these near-term low points, these near-term peaks coming from each near-term high. There's that peak, and, you can see there's also this one, too, really coming down this intermediate peaks. You can see there's that peak that we still haven't quite, depending upon how you draw the line, trying to connect those peaks as best as possible. Those are the intermediate peaks. So we haven't quite broken up above that. And again, depending upon how you draw this line here, you could draw it something like that, how it was right there before yesterday. That's kind of more of a triangle pattern that we had going into yesterday. So we had a nice good close above that downward sloping trend line on the near term basis. Not quite yet up above that downward sloping trend line on an intermediate basis, connecting the green line's peaks that are above 50. This one being the most recent one right here, and then having this near term low point underneath, a higher one with these higher near-term lows on the index itself. So bullish posture, getting above 50 is a positive sign for the S&P 500. You can see, with this intermediate line, we have higher lows here on the intermediate line with lower lows on an intraday basis here on the index itself. Another positive. Now, granted, here's the peak on the near-term line in between those higher lows. The corresponding peak on the S&P 500 is right there at about 2680. You're not going to be really bullish, and you can see by Monday you're most likely a break above 2680, which would be the near-term high. Will most likely also be a break up above that downward sloping intermediate trend line. So that's the kind of move you're going to need to solidify what is now another bullish posture, with the intermediate line turning higher and getting up above 50. All right, that's what you're going to need there. But the long lower shadow yesterday, we talked about that. I tweeted that out, the long lower shadow alert. I tweeted that out there here that we were getting a long lower shadow, closing up above where we were yesterday. So a positive sign there for stocks. That was a positive sign. And then closing today's candle, even with the gap down that we had initially on the employment numbers, finishing, right from the outset, we started higher and then closed higher throughout the days. You'll see with the rest of these charts. You look at the Dow Jones Industrial Average, very similar pattern. You can see the momentum line spiking up above 90 is a positive sign for the momentum line to see that kind of a spike. That's a signal. I mean, there's, nothing's 100%, but it's a signal that we haven't had that kind of a move, that high of a momentum line during this whole bearish swing that we've had with the market sentiment line down. So that's a sign, kind of a canary in the coal mine, so to speak, that the trend is changing. Now, again, you still got this downward sloping. You've got to get up above these highs. But coming off the long lower shadow yesterday, closing above the last 3-day highs as well as the moving average on the Dow Jones, positive signs galore here for stocks. Here's the NASDAQ composite getting above not only the last 3 days highs, but multiple days worth of highs. So a very strong move. Also a momentum spike up above the 90th percentile. Again, we haven't had that for a while. And then the intermediate line crossing above 50 again. So coming off a higher intermediate low, crossing above 50. So a bullish posture in that regard. And finally, the Russell 2000, which has been more bullish. Again, not quite closing above the high there. That high was 1565.37. Oh, we did. A smidgen below by 23 cents. We got up above there. So closing above, including that high, all of these other days worth of highs too, with a couple of days of long overshadows in there. And a third one there if you count this day where my cursor is. So getting above the moving average easily, unlike the large cap indexes, and you can see its intermediate posture bullish too, and higher up above 50 than all the rest. So, which is a positive sign. You want small cap stocks to have a more bullish posture. And again, you can see that this bottom never did get below 50, so you wouldn't count that as an intermediate low point. You would count this one and this one. So we're getting higher while we're kind of coiling here on the Russell 2000. Draw these lines. Let's draw the line there. So we're kind of coiling here eventually on the Russell 2000. So there's the peak, again, depending upon how you draw. Nothing's too precise in these drawings, but there's your coil. There's the move you had, the bullish move you had going into the coil. So that's the move you expect, whether it's to that length or not, it's doubtful, but that's the move you expect to come out of the coil because of the trend. Alright, if you're watching this video on our blog, and again, you can get to that blog with that link that just popped out in the top right corner of your screen. If you're watching this video on this blog, you can let me know with 3 clicks that you want me to do these videos. You want us to keep doing these videos. And those 3 clicks are, again, down below the video where you're watching right here, embedded in the blog post. Remember, in here you can speed it up, you can change the resolution, you can add closed captionings, you can watch it full screen. But here's the 3 clicks. 1 is to like it on Twitter. That's embedded right there. 2 is to like it right there on the Facebook post, if you have a Facebook account, to like it there. And then 3 is to click here and like it on the blog. Those 3 clicks tell me, number 1, that you liked it, and number 2, they tell me that you want me to do it again. Keep doing these videos day after day on YouTube for free for everybody to see that you're getting value out of them. Remember, you can also join our daily Market Outlook email list right here. Now, I want to hear from you about what you're thinking about these videos, and you can do that here in the forums. Again, there's a link right there. There's also a link in the top right corner of this video that just popped out. That will take you to our Market Outlook forum. You have to subscribe to our site to participate in the forums, and you can do that for free by subscribing there. But click in the forum, participate. Let us know what you think about tonight's Market Outlook. What did you see? What input? What comments do you have? What did you learn? And again, if you want if you want to subscribe and get the more premium elements of our site as we build it here, there's a link right down here that will give you more information on what we're offering to our premium level subscribers right above that green like button there. All right, when you look at the weekly chart, again, you can see that we continue to get we continue to get another long lower shadow. We're not quite above that 50-day moving average yet, so you don't get a green arrow on there. Not quite above that 50-day moving average, but you can see how the 50-day moving average is tightening up. You can see how we're, the gap between the two, this decline that we have on the MACD, which measures the gap between the two long-term lines, is starting to flatten out a little bit. And long lower shadows are very positive from a bullish standpoint. As you saw yesterday on the daily chart, we're continuing to get that on a weekly chart as well. Which just goes to show, yeah, we've been bearish here and there, but by the end of the week, which is what matters, the closing price of the day, the closing price of the week is what matters the most. And the fact that we close going into a weekend with a much higher price than we had any time during the week, it goes to show that that's a positive bias for stocks. When you look at the 3 green arrows, you can see we got 2 green arrows. So we're back up above the moving average, which is that red line right there. You can see where my cursor is. It will turn green because you can see how it's turned up. So on Monday, that line will turn green. You're above a rising moving average. It was red going into today because we were here yesterday. We were below a falling moving average. So that line will turn green tomorrow or on Monday. And we got the green arrow, so we're above it. And you can see the MACD doesn't have the green arrow quite yet, but the stochastics is turned up and giving what is a phantom green arrow. So it's turning higher without falling into the reversal zone. That's more bullish than getting a regular green arrow like that one. When I break out the chart into its separate lines, you can see how they've all converged. I mean, the 8, 17, 30, the 8 and 17 exponential moving average, which is what's used in the MACD, and the 30-day moving average, the 6-week simple moving average, they're all just sitting right on top of each other. The 8 is not quite above, so that's the green. It's not quite above the red, so that's why the MACD, the blue line here is below 0. And then the blue line is still below its moving average in orange, and that's why you don't have a green arrow on the histogram yet. But you can even see, when that MACD is sitting itself, the blue line is sitting near 0, especially the moving average too. That's about as flat and neutral as you can be. A little bit of a downward bias because they're pointed lower. These lines are going down. But this is a more bullish day than we've had all this whole time. So when you're looking for a potential for breakout, now not a whole lot of volume yet, but when you're looking for potential for a breakout, that's a positive development, especially when you're looking at stocks, the other indexes like the Russell 2000, which you can see again closing above all those highs. Its MACD is above 0. Both the 8 and 17 are already both above the 30, which is a positive sign, and the MACD itself is close to crossing above its moving average above 0, which is good. And the stochastics close to forming a phantom green arrow and close to crossing above its moving average too. So again, a more bullish day than we've had in the last couple of weeks is the best development for the potential of a breakout than we've had here recently. All right, when you take a look at the day, we started off down, gapping down, but we have a higher low point than we had yesterday, as you can see here. And then you see how we broke through early yesterday's high, broke through almost immediately that orange line there, which is the 4-week midpoint. So we got through that really, really quickly, and then rallied up through all these highs. There's that day's high, Tuesday's high. We broke right on through that, pulled back a little bit, but with a lot of buying here at the end, coming off the low for this hourly or 30-minute candle. So bullish day, and closing above those highs is very positive. Again, more positive candle than we've seen in a while. When you put it when you put it together with that long lower shadow that we had yesterday, so that move off of yesterday's low from 259 all the way up to 266, very positive sign for stock. There you can see I've updated to bring this 4-week low point up, and because of that, it actually moved the 4-week high point up a little bit, and still trading today, getting up above those highs and getting back above the 4-week high point. Positive sign. Now, keep in mind, after today, that low point is going to get moved up to right there. So it's going to bring the 4-week high point up as well, probably up into this area. So we'll see if Monday, if we are able to hold our position in the upper half of the chart, which again is more bullish when you're in the upper half of the chart, obviously, than when you're in the lower half after, just a brief little foray that we've had. We've been moving this 4-week line up here lately. It was more down in this area before the last couple of days, and we've been moving up that 4-week low, and the gap between the 4-week range is shrinking. 258 to 271. Now it's going to be roughly 259 to 271.3. And again, when you have the low point to the right of the high point, that's not the best sign. So that's why I'm not the most bullish yet. It's a positive day. But when the low point is to the right, the 4-week low is to the right of the 4-week high, you want the 4-week low point to be over here and the 4-week high point to be over here. That means we're pushing up higher. We're not quite there yet, and we'll be more bullish when we get to that point, and we'll be more bullish when we establish ourselves firmly in the upper half of the chart in this area without flirting around the midpoint like we've been pretty much all week. When I look at the daily chart, you can see the volume coming in about 91 million there. So a little bit below average, and you can see the trading range. The ATR is 4 points. Today's range was over that, 5 points. So positive, that's, again, when you're coming off a low point, your bullish days will be bigger ranges. As we get through these highs, you'll start to see it slow down again and get down into this area. You want 1, 2, right now even 2 to 3 point ranges will be enough. Probably 1.5 to 2.5 point ranges will be what you start to see as we kind of grind our way in through this mess. See, if we get going and bounce up, we're not going to spike up. We're not going to get this kind of a move at all. We're going to have a lot of mess to get through in this area. So we're just going to kind of grind our way with more volatility than what we might be accustomed to from last year. And you can see how the volume on the long-term basis continues to decline. These lines are continuing to decline, and we are at a very, very high peak. In fact, when you look at the ATR on this basis here with this chart, and I'll just take off the, again, we had a 1% move. It's the 2% moves that will be more bearish, and we probably won't get very many 2% moves. As we get established, we won't even get very many 1% moves. But a 1% move to the upside is a positive development. Get rid of that one, and then just get rid of these other lines here for a second so I can see the ATR nice and easy. And this is the ATR now, not on an absolute basis, but on a relative basis, right? And so, 1.48% of the current price of the index, and you can see not as high as it was back here when the ATR got really, really high, but high nonetheless, and higher than we've been all last year, and even higher than the peak that we had in June of 2016 when we had the Brexit vote really raise up volatility, and that ended up being a really significant low point. But nonetheless, this is the last time we've been this high for this long since these more significant low points that we had. That ended up being pretty good launching pads for the S&P 500. When you look at the VIX on an hourly basis here, you see how it's still, it started up higher because yesterday we got all the way up to 18, not quite through 20, but pulling back, and the actual VIX compared to VXV, look at this, breaking below 90%. That's the lowest break and close that we've had in a long, long time. So, not quite getting as low as we did back here in mid-April, but that's another positive sign for stocks, the fact that volatility is now finally closing below the neutral range and into this bullish area, with 85% being kind of the sweet spot there. When we take a look at what's driving the price action today, of course, the employment situation was the biggest news out this morning. Numbers coming in below estimates and below the private payrolls report we got on Wednesday from the ADP. Still, with the participation rate doing what it's doing, you can see dropping down a little bit there. That brought the unemployment rate down to 3.9%, the low end of the range of the estimates, below the median estimate there. You can see the private payrolls coming in below estimates as well. You can see the price of earning, the average hourly earnings on a year-over-year basis also coming in below. So a little bit of a, that's been rising here, and the fact that we have a year-over-year small declines, a positive development. Now, that hasn't stopped the rate hike odds for June from getting to 100% from the futures contract. This is based on the futures contracts, right? So 100%. You can see the third rate hike for the year, which again on a quarterly basis you'd expect it in September. Well, now the odds have gone up, or at least are at about 75%. You can see actually went down a little bit with today. It was above 75.7. Now we're at 73.7. So down a couple percentage points, all showing up over here with the only one rate hike. And of course, by December, what are the odds of having the fourth rate hike? So there'd be 1, 2, 3. This would be the second one for the year, because we're at right now 150. Third one for the year and fourth one from the year. So you can see here the odds actually dropped for getting a rate hike by the fourth, getting a fourth rate hike by the end of the year. Now it's still, over 40%, but still now, according to that, you almost have high probability that you only get 3. And the market's been kind of vacillating between 3 and 4 for the calendar year. The Fed's been kind of trying to give the idea that there could be 4, but today's data point, even with GDP estimates still based on yesterday, still holding out that 4% rate. Now, granted, that's very early, and this has a history of dropping, so grain of salt there. But even with the history, of strong economic indicators, and pulling back today, but still at 30.9, and strong GDP estimates based on those on current indicators, we still have less of a likelihood because of what the market saw here with the softening there, and the softening on the year-over-year growth rate a little bit too. This is the year-over-year, the pink line, the year-over-year growth rate of the S&P of the employment report, and of course, this is the biggest one, softening on the earnings growth rate, which that leads to higher inflation when workers are making more money, obviously. When you look at how all the asset classes are doing, crude oil continued. You see crude oil had the best performance today, up almost 2%, and that's driving it up to the best performance of the past 2 weeks. That's what this chart's showing us, a 2-week performance, up 3% for the week. You can also see other agricultural commodities doing very well too. The blue line you can see up here is the U.S. dollar. The U.S. dollar has been very strong. It's up a little bit today, not up as much as some of these others, up a little bit today, whereas the rest of these that were really struggling, you can see coming into today, there's your S&P 500, it was down. The emerging markets was down. There's your foreign bonds. Both of those are still down. Gold is under pressure from the dollar. Well, the gold outperformed the dollar today. The only things that really pulled back the most were those agricultural commodities, because they've been doing so well. They pulled back a little bit. There's a lagger that continues to lag behind. Everything else is flat. These areas are more flat, but stocks doing well. S&P outperforming the small cap index. So there's the S&P 500, and you can see the IWM. I'm getting used to these new colors. For me, is right here where that tag is, IWM. You can see over the 2-week period still outperforming, small cap still outperforming. Positive sign, even though S&P outperformed it by a smidgen today, but that's a positive sign too, to see emerging markets outperforming international. And you'll usually see these two outperform when the dollar, international stocks, when the dollar is up. Right? When the dollar is down, you'll see these international stocks do better, generally speaking. But crude oil, crude oil has been down a little bit. It's been doing so well, it pulled back. In fact, if you take a look at this on a longer time frame, let's just go to, here it is on the 1-year chart. So this is over the past year. Crude oil is up 50% over the past year. Talk about inflation, right? Crude oil is up 50% over the past year. And then down here you can see where you have the dollar, and so the dollar's been very, very weak. There's your agricultural prices, why they've been doing so well lately. And with that dollar being as weak as it's been, emerging markets has been a good performer, usually coming up with crude oil. Well, crude oil's diverged away, so something's going to correct here, because those two tend to go hand in hand. A lot of emerging markets performance comes from these commodity-based economies, and so either emerging markets are going to start to pull back up, Brazil and Russia, and some of these are more tied to crude oil prices, or crude oil will, start, a lot of this is fluff in commodities, and that will pull back. The question is the dollar, and if the dollar pulls back, it'll be harder for crude oil. If economic growth expectations pull back, you'll start to see this come back too, crude oil come back. But that's not the case right now. The dollar's on it, even with its decline, its bullish move, and the dollar is this blue line right here. Even with its bullish move lately, it's still one of the more underperforming asset classes. And let's take a look now, like at a 6-month or a 3-month chart here. So there's your dollar. It's been really doing well lately. Before that, not as well. And there's small caps up 5% over a 3-month basis, even with the S&P 500 barely showing some small gains over a 3-month chart. And there's crude oil taking off. Gold down here with the strength in the dollar. Long-term bonds down here with the strength in stocks, and especially the strength in those small cap stocks. Industrials have had the worst performance over the past couple of days or weeks, with real estate utilities doing very, very well. There's technology and energy, discretionary, all outpacing the broad market, and everything else here declining. But see, today's moves was driven largely by that outperformance in XLK and XLY, and you'd expect those on a risk-on day. But look at that. XLP, which has just been, getting hammered. And XLP is this pink line here. It's been hammered here lately. In fact, look out longer time frame here. We'll go out, 180 days. Here's a telecom, kind of on its own, a few stocks in that. But look at staples, really, really lagging behind. And of course, you have your other utility sensitive areas. There's energy, technology, and discretionary outperforming the broad market with financials. But, staples has been just getting absolutely hammered. Today, finally getting a little bit of a bounce. And that's something I also tweeted out here. Here we go. I tweeted out here today that we had a nice, good candlestick pattern. Look at that morning star candlestick pattern coming off of multiple days of clusters on the market forecast indicator. This might be one of the best times for staples that we've had in a while. In fact, you can even see from these intermediate low points that are slightly higher. So we had all these clusters on that dip. And then we had a new intermediate low point after a small peak above 50 there. So a lower intermediate high, lower low. I'm just looking at intermediate low points. That was not a lower intermediate low point on the intermediate line here. So in fact, even on these two little smaller dips, you can see a lower low. So there's divergences setting up with this Morningstar candlestick pattern. And as I mentioned, I'm not the only one pointing this out. As soon as I tweeted that out, the CNBC said, hey, you should check out options action tonight because we've got a trade coming on. So I'm obviously not the only one that's looking for some opportunity here in XLP. And of course, remember, just a couple nights ago, we talked about CL getting to where it got to, hitting some very, very strong support, looking like the bleeding had stopped to that point. So for our trade idea of the day, I wanted to take a look at another one of those stocks. I know I looked at CL before. This has kind of been a common theme. Procter & Gamble being one of the bigger companies within the XLP weighting and having, a bullish close itself after multiple clusters over the past week or so. So starting to jump up higher, not quite yet above the divergence high. And you can see, after gapping down on earnings, 75 is going to be a resistance as it tries to make its way up. So it's not, I'm not looking for it to make a move back up to 90 anytime soon. But if we can get up to 75 or in that area, I think there's opportunity there with that divergence as well as the gap and just the overall bullishness of the sector and the potential for outperformance there. This being one of the bigger movers and this being really one of the biggest laggards within the sector, able to start to rotate its way towards the upside. That being said, if you take a look at the options chain, we say, okay, well, if I were to take a look at this June expiration and thinking, well, it can get to 75, there's potential. Well, I don't want to buy an option that's going to expire there. I'll go out to July and I'll buy that 75 call option out here. You can see buying the 75 call for 98 cents. But because of the risk of coming off this low that we're at. I'm going to reduce that risk a little bit by coming to June and selling the 75 June. And so what that does is it makes a calendar spread. So I've got a long call, but instead of paying 98 cents, I'm only paying 45 cents. So I've reduced my risk there. I've also capped my upside, but I don't think there's a lot of upside to this. I think there's going to be some resistance around 75 in that area that's going to kind of muck it up a little bit. So if that happens, here's what it looks like. My maximum loss is 45 bucks, but knowing that we're not going to take a $45 loss, if it starts to get below this low point here at 70 3/4, so down in this area, then we'll probably end up taking about a $15 to $20 loss, depending upon the day that it does that. If it were to break back down and pretty much nullify this bullish candle that we've had. So the reality is I'm probably not risking the whole, even though I'm going to position size around a $45 loss, because that it's always possible. The most likely scenario, I'm going to lose about 20 bucks if this thing were to turn right back around and go down. You can see I'm already in a spot where the price is at currently, where I can get positive time decay. So I don't really need it to go up too much for me, and I'm right at that crossover point there that I'm pretty much at break even right now where it's at. It just needs to kind of stay up above where I'm at. And the longer it stays up above, and as we get up to 75 and it kind of mucks around there, my potential reward in that area is about $90. So I'm getting about, for my real risk, about a 4-to-1 profit to loss ratio. And of course, I won't get that until you can see that as time passes, that purple line will start to make its way higher. And this is on that June 15th expiration. So as I get to that last week, right here, June the 11th. So there's the Monday. In reality, I'm going to have about a $50 gain for that potential $20, $15 to $20 loss. So about a 2 to 3-to-1 profit to loss ratio. That if we continue to muck around in this area between 74 and 76, as long as we're trading within that 74 to 76 area, I'll make, according to the green line, at expiration, I'll make $50 or more. So here's where the $50 mark is, and I'll add on another slice. I'll move that slice to right where that $50 mark is. See where my cursor is, and I'll show that on the chart. So set those slices to the chart. So if we get into this area here by expiration, then I'll make that $50 or more for the $45 total risk I'm taking, but in reality about $15 to $20 actual loss I'll get if we happen to close back down in this area below 73/4 and renew this bearish move. If we stay here or higher, then time decay will just kind of make me money in a little bit, but make me money, minus commissions, of course. As always, that wraps us up for today. I appreciate you watching the Market Outlook video tonight. And remember to subscribe to our YouTube channel, like today's video by clicking thumbs up, comment on anything that stood out to you. Remember, you can do all of that too on marketscholars.com. There's a subscribe button up in the top right corner. You can like today's video down on the Market Outlook blog post for today, as well as comment on that same blog post on anything that stands out to you. Again, have a great weekend, everybody. Thanks for watching, and we'll see you all on Monday.